We will stand on principle, or we will not stand at all.
Hello, everybody. This is Thierry Ruiz here, and this is another episode of Principal Discord. This time we are with Mark Valek. Mark, an expert in gold, Austrian economist, and also fund manager at Incrementum. Mark, thank you so much for being here.
It's a pleasure, Thierry. Hi.
So, Mark, you have behind you, if I'm not mistaken, some of the major bubbles, which is the tulip bubble. That's correct. What do you think is the major bubble today?
Well, I think most of the bubbles have actually the root cause in unbacked currency or unbacked credit and the excess credit, which is kind of created by either a central bank or by the commercial banks. And if you have this kind of worldview, we have a gigantic bubble. We often refer to it, and others often refer to it as the everything bubble. Some people say the everything but gold bubble. But I think it's been pretty obvious in the last, say, 12 years that central bank printing has been rampant, and we saw the effects on the equity markets. We saw the effects on real estate. And so we definitely saw the effects in the bond markets. I think in the heart of all this bubble is the bond bubble. So if you have negative yielding government bonds or even corporate bonds, that's to me clearly a sign of a bubble, because that just doesn't make sense. Negative interest rates don't make sense and are a function of this monetary system. So a lot of bubbles currently, if you ask me.
Well, what's funny is that the money market is much bigger than the equity market. And when you talk about the everything bubble, it seems like the bubbles have moved from one asset to the bigger asset pool, to the bigger asset pool, to the bigger asset pool. And I'm thinking right now, derivative market bubble, and really ending up into this massive money bubble where even money is put into question, where you have central banks just printing money with no tomorrow, no boundaries, everything goes. How far can we go as far as the central banks are concerned?
Well, that's the $1 million question. I wouldn't even call it like that. It's perhaps the 100-ton gold question. Yeah, I think probably the limits are the trust of the users of the medium of exchange. And right. The trust is probably, will really be called into question if price inflation really turns up significantly in the supermarket, because then everyday users really notice it. And I would make the argument that it is already here, and it has been already here since years. But it's even if you distrust the official numbers, and I think there's some reason to do so. Yeah. It hasn't been hyperinflationary or anything close to that, at least in the Western world so far. And only once this gets even more obvious, this rampant monetary inflation turning into not only asset price inflation, which we have seen, but consumer price inflation, I think this level of trust into the everyday medium of exchange will be questioned more and more. So, a
lot of people are looking at the CPI. I just saw a post recently about the Big Mac index. Big Mac in 2009, peak of the global financial crisis, you had a Big Mac at $2.5. Wages were minimum federal wage were about $7 or so. Fast forward to today, the Big Mac is about $4.5. Minimum wage still the same. It seems like there is the haves and the have-nots. Those who have financial assets, as you said, they have largely benefited from this. Those who have nothing, not at all. So the disparity has been pushed, and it seems like there's been a moral hazard created by this easy credit to the ones who have money, and these tightening conditions and uncertainty to those who don't, because we're in a globalized world that even the pandemic now, when you have all of the people working at home, why would you pay Swiss salaries if you can pay Mexican salaries, for example, for the same type of skill? A lot of people, so touching on that, a lot of people would say, yes, Mark, but we don't see inflation. No, we're blind to it. Where is the inflation? We only see asset inflation. We're looking at the CPI. Maybe in order to push inflation, it's very hard because we have structural deflationary pressure from wages globally of people competing, from productivity, from technology, which by and large since the 1980s have been a deflationary pressure that is a structural thing. So how would you see inflation push its head through in a way? That's kind of like the question I'm guessing central banks are trying to solve right now.
Yeah, I mean, you're totally right to point out that it is a very complex topic. So you have a lot of different dynamics going on. You have deflationary dynamics and you have a lot of inflationary dynamics, and these two dynamics collide. But it's even more complicated than that, because obviously you have a whole array of different sectors. I mean, what are we which prices are we talking about specifically? I mean, for the classic consumer price inflation, first of all, I think, as I said, I think we already have more CPI, or we should have a higher CPI than it's perhaps stated. There are a lot of effects which dampen the numbers. For instance, shrinkflation. I mean, you get the same, some products, the prices stay the same, but the quality decreases, you know. So that's obviously a big. Look, think about airplanes. I mean, this is not a big topic right now during the pandemic, but the last years, you know, the space got smaller and smaller, and the service got worse and worse. You had to pay up extra for a bag and for drink and so on. That was the prices came down, but the quality came down also a lot. You know.
Yeah, so you had the can of Coke that was at 500 milliliters, then 350, and now 250. So yeah, I get what you see. Yeah.
So this is really a very the whole concept of measuring price inflation is flawed, or is just complex and difficult. I'd argue you really can't measure it correctly because of so many factors, quality and all these kind of things, you know.
Okay, so changing gears a little bit. The monetary landscape today, it seems like every central bank is doing all of the same thing, right? If I may ask the question really as of the long shot, imagine there is two-tail risk where there is hyperinflation on one tail and deflation spiral on the other tail. Which one you think is going to come first?
I mean, we saw dips of deflation. We saw very deflationary events during the last 15 years, one being 2008, 2009, and the last one even this year, March 2020. So you had a lot of money basically either being destroyed because the banks just didn't lend out any new money and actually took back their loans. So it was a contraction of money supply, definitely in the year 2008. 2020, perhaps it was more the velocity dropping to zero or dropping down to very low points. Also happened in 2008 on top of the contraction of the monetary supply. So these were highly deflationary events, I'd say, as an aggregate, if you want to look at what's going on in total. And we saw what in both incidents central banks did. They reacted harshly, and they reacted even more harshly this time around, and even faster, more rapidly this time around. So deflation really is something which is not being. This system is not supposed to have deflation. It just can't. It's just an inflationary monetary system. I think the root cause for that, the really deep root cause, is that it's debt-based. So in both layers of money creation, first layer being the central bank, the main assets now are debts, are government bonds, and in the second layer of money creation, which is the bigger layer, commercial banks, the money is created as loans, you know, in both.
No, I see what you're getting at. Basically, you are in a funnel where you have racks on racks on racks of debt building on top of each other, and at some point the top becomes so large and the bases become so small that you can tilt at any point, either one way or the other. But do you think the destruction of this debt-based system, which I would say, in an ideal world, all of this will collapse back to one with gold, which is the sound base of money, and I think in this we would probably agree. But again, what would you see that coming first? A hyperinflation that would burst it this way, or an implosion of a deflation bursting it from within? Which one of the two is going to happen first in your view?
Well, I think the picture you painted is a very good one, a very accurate one. I mean, it's I don't know if you're alluding to Exter's pyramid, but that's exactly I think what he also wanted to show with that picture. And for those people who don't know it, Google it. It's very interesting. We wrote about it in one of our In Gold We Trust reports. But Exter's pyramid has gold at the bottom, and I also see it similarly. If like all this debt-based money, which was inflated on top of this little small fundament, gets out of proportion, you have exactly this danger of either it imploding. That would be what perhaps more classically economists call debt deflation, and that's the event what nobody wants to have, because it's so dramatic. Because what that means is people who have money at their banks just lose it, because it would be a massive collapse of the banking system at the end of the day.
Right.
And so that's why I don't think that. I mean, I think that the system is always prone to some kind of a deflationary collapse, but with unbacked currency, unbacked fiat currency, the central bank can always fend it off by printing these enormous amounts of money. So I think it has the tendency for deflationary collapse, but they always, till now, were able to back up the pyramid with freshly created money, and still it's wobbling, but it's still standing. But if I mean, at the end of the day, I think, first of all, it's important to say this monetary system is not sustainable just because of this property of the monetary system. It's growing in an exponential path. And ironically, in times of a pandemic, we should have had a crash course. The public should have had a crash course in exponential functions. But it would be good if they applied this knowledge on the monetary system. It's also an exponential function. Just look at any kind of aggregated debt statistic. They are all like exponential functions. So just looking at that should make everybody a little bit suspicious, number one.
Mark, you spoke about the pandemic. Let me interrupt you. It seems like right now a lot of it is behavioral finance also, right? Because there's this reflexivity component of markets are going up, therefore markets are going up, therefore markets are going up, because the money is being printed, and so far the only thing that has been valid for the money printing is the assets. But so the behavioral impact of this on people, and also on where are we standing today when it comes to the solutions? It seems like the solution proposed is increasingly to replace the private sector by the public sector, who's rescuing everybody. It seems to be that instead of printing money in a way so that there is a trickle down wealth that has failed, doesn't work, and so we were going to go into MMT, helicopter money for everybody. Do you think that's feasible? Do you think that's where we're going next?
I think the system demands this kind of next level too. Right. If it should be sustained for even whatever period longer. But it's just necessary that this new currency which is created now should rather go to the public rather than to the asset prices. I mean, it's also a political question, but also from an economic point of view, just to get this velocity back up. And just to, I mean, I think even central bankers have understood now that the kind of traditional way of inflating via asset purchasing programs, by definition, it pumps up the asset values, and that's perhaps also can work as a trickle-down economics, which it's called, but it causes these inequalities and so on. And now I think with all this digitalization and with the talks of digital currency and so on, I think that is actually quite there's a connection to the need for the system to have more currencies in a broad level, and digital currency could be a way to kind of disseminate the
right.
currency.
So you're talking about CBDCs, central bank digital currencies, and that would be the mean of some sort of a helicopter money, MMT distribution type of measure that you could see. But okay, so in principle, Discord, we like to speak about principles. And I think the value on this is that if you remove yourself from the situation enough and you see things from a higher level, you discuss the major principles that are actually at play and see if they make sense. I think one of the principles, okay, is money itself as a store of value, as a medium of exchange, and as a unit of account. It seems like the fiat system has two of the three, which is the unit of account and the medium of exchange, but it has largely failed as a store of value. Is fiat money on principle or not? And what is money then?
Yeah, I mean, I agree with you, and I think also the store of value property perhaps was still in place for quite a while, still perhaps until, I don't know, mid 2000s or so, at least if before the zero interest rate environment which we have entered after the great financial crisis. So now this store of value function definitely is in question. And
I would go as far as to say that the store of value has ceased in 1931 with Truman and the executive order of unpegging to gold. Because since then, we don't really see what the base of the system is.
In principle, I agree with you, but I mean, I'm located here in Liechtenstein and come from Austria, and I mean, I have contact with continental Europe, German-speaking countries, and the perception of the public towards fiat currency still was, and to some extent till today still is, as a store of value. So in principle, I agree. But I mean, just look at, say, for instance, German culture of storing their currency at the bank. Usually they don't do anything else. I mean, they have gold and they have now a little bit equities and so on, but they're really not an investment culture. There are billions, and in Germany it's trillions of euros sitting at the bank. So that in practice till today, it is being used as a store of value, even though the public is more and more aware that it's it's a bad store of value.
That's interesting, because when you look at the ECB, for example, and largely what central banks have done is essentially what they call push you on the yield curve, or on the risk curve, by the way, which is both of things, right? But if you're being pushed on the risk curve in order to save yourself from the erosion of wealth, right? How do you protect your wealth? And now, increasingly, you have to go to very risky assets in order to maintain that wealth. It seems to me that because of the cultural issue here in Germany, it could backfire by people saying, you know what, I'm not playing that game anymore. I've seen what happened in 2008. Instead of going to preserve my wealth through financial products, let's go back to the basics, onto property, onto stable assets, onto gold, because there's a real fear out there. And I think one of the millennial solutions as well is to shove in these digital currencies like Bitcoin, which are basically just saying, hey guys, we're just new in this game. We don't know too much about economics. We don't know too much about history, but we do know that money doesn't make sense right now with the fiat money, because we understand the Federal Reserve System from YouTube videos and things like that. And so we try to produce this one thing called Bitcoin to solve that problem, even though I personally think that it fails at doing it because it's kind of like a millennial's fiat. But at least there is signs on the market that people are really fed up of this system, where they don't see it function for the vast majority of people, and they don't, without going too much into details, and they also don't see it work over the long term. Like you say, it doesn't seem to be sustainable. So it's like we're in a gigantic Ponzi scheme, and what is going to happen when there's a monetary reset, right?
Yeah, valid thoughts. I mean, I think it's the central banks with zero interest rate policy or negative interest rate policy created the perfect dilemma for the saving public. So if you take a typical conservative saver, I call him, not investor, perhaps a elderly, say, German couple, just as an example, they don't want to take risk. They don't have the lifespan actually to be able to tolerate volatility actually. So
right.
so what do? They can either just accept the fact that in real terms their savings are just losing value each year, or they at the end of the day just do take some kind of a risk, and some things which you mentioned, property and so on, and I'd say even the stock market, gold, but all these things have now become kind of as a surrogate, as store of values, which, I mean, one can argue that stocks are a store of value, but I would say that's the wrong term. It's an investment. It should be
That's
an
right.
investment. Yeah, so it's a good thing to invest in stocks, but one has to be aware of the risks. And even if these people are very aware of the risks, that's actually why they don't want to go there, because they're so conservative. So what do these people do at the end of the day? And until the pain in terms of negative real interest rates, so in terms of loss of purchasing power, becomes too big to bear, they will sit on the sidelines, and a lot of them have been sitting on the sidelines. But some of them have started to go into the equity markets, go into the property markets, and I'd say the problematic thing is they have been doing well. Problematic insofar that now they actually think it's not even such a bad thing.
It's a bonanza, right? And I think, looking at my experience on the markets, it seems like, well, first of all, you have to have two different risk profiles, right? Not everybody wants everything. Like you said, some people have a lower risk profile and some people have a larger time horizon, I would say. And one of the problems, by the way, is the pension issue there. That could really turn in sour. But this is a completely different topic. When it comes to comparing apples to apples, the way I see things is that gold is money. It's not an investment, okay? And everything else is assets. So this is not supposed to make you money, but this is, right? And then the investment is there to provide you with yield. Money is not supposed to provide you with yield. Unfortunately, a large pool of the investment assets pool, such as bonds now, are negative yield. And negative yield means, relatively speaking, zero yield is better than negative. So there's already an inflow there that can be created. Right. Then the second thing is, over the long period of time, and particularly in crisis periods, it is more often than not the person who has as a first rule, don't lose money, that makes the most money, as opposed to the person who wants to make money by being on the risk side, who actually loses the money. So, counterintuitively, it's more often those who are more precautious, because they will see the inflows of the assets when the crisis comes. And let's be honest with things. On principle, we are on a recession. That's a fact. And we are thinking, is this going to be a depression or not? And there is a lot of signs out there that could look at that. And what is the most likely outcome when it comes to those FOMC people, those academics, right, who are at the central banks, who only have one button, which is print. And so what is the most likely outcome? The most likely outcome is, and you see it flat out from Christine Lagarde when she said, we are going to do X, Y, Z, which is more, by and large, more monetary mass. But we also need now fiscal measures. We should not be the only player in the game. We should also push for government, which supposedly you are independent from them, but that's another question. Governments need to step up. That's the punchline. Where is this going to lead us? Are we going to be in a system where, on principle, everything is run by the central bank and the state? By the central bank, because then why don't you, if you're distorting one price, which is the interest rate, and then you distort the long bond, and then you start distorting the equities. Then why don't you, like, are we even in a free market anymore, right?
No, I don't think so. I mean, one can argue, have we ever been there? But I mean, we've been definitely in environments which were more leaning towards more free market philosophy than today. And I agree, this whole dynamic is actually centralizing a lot of powers, even more than we've already had seen. So yes, the state, in combination with the central bank, will become even more powerful and more important for all the activity what is going on. That's, in my view, an unfortunate development, because it's also will cost prosperity, because its central planning is not as will not produce an as prosperous outcome as a decentralized planning. Just by definition, if you read Hayek. The knowledge is decentralized. It's not centralized, and that's why you need a market to coordinate this decentralized knowledge. And the more you centralize it, the more you start planning it, the more negative effects it will have. So there's a whole lot of disadvantages to this dynamic going on. But what I wanted to just also add to what we were discussing previously, kind of how to invest and risk versus non-risk. I think one has to acknowledge that in an monetary inflationary environment, that's just it enhances speculation, and it's actually the perfect environment for bubbles and for speculators. For instance, I was really, I can recommend, you probably know the book. I was really deeply influenced by the book When Money Dies. And this describes hyperinflation Germany and very in detail, I think, with a lot of small anecdotes, how everybody actually had to speculate just because the store of value was so bad. You just need to find some place to put your currency in as soon as possible.
The tragedy of this is that we see it play out again with Venezuela.
Right.
It's not like the knowledge is not out there. It seems like we always repeat the same mistakes, and it's never this time is different. It's just the means are different. But
yeah. So. But sorry, I just wanted to say.
Go ahead.
I think. I mean, one doesn't even have to look to Venezuela or something like that. I think this environment where the West already has a lot of similar characteristics as this speculative bonanza had during Weimar Republic. Obviously, by far not this dimension yet, but in principle, again, the public faces the same problems as the public then. They are, as we were talking about, looking about what to do, how can we transfer our wealth into the future, because that's a basic need for all the people who need to take care of their retirement or whatever. And so we have to acknowledge this is an age of speculation, and the root cause is this huge wave of monetary inflation, which is being created.
So is it correct to say, Mark, that you think that everything points towards more monetary mass, more printing, and so therefore one has to be prepared to face that? Because to me it seems like the first phase was to create the gigantic monetary mass. The second phase will be to accelerate the velocity of that mass, and that's when things are going to kick in. But so everything is going to have to do with that second phase. Are we going to launch the velocity, yes or no? And if it is through MMT or through coupons and rationing tickets, God knows what is going to be, then we can see a hyperinflation and one can position itself. The other option being the monetary mass collapsing upon itself, which ultimately, in my view, it will happen. It's just that we might see a first phase of hyperinflation before we see the total collapse of the system. Would you agree with that, or do you see there is a higher likelihood of things collapsing on their own?
No, I would pretty much agree to that. I think also, if you think about this whole debt situation, and with this virus, I mean, this debt situation is getting even more and more out of control. So this debt situation, this trajectory of increasing debt, is actually guaranteeing already even more monetary inflation with or without higher velocity. And so I think
you're going to monetize it.
yes, they will have to monetize much more debt going forward. I think that's totally guaranteed. And then you have this option of the velocity at some point, whenever, kicking in on top of it, and that I think could be the time when things get out of control in terms of price inflation, because then the big question is, can they stop it? And how can they stop it? They probably could do it pretty easily by raising interest rates and so on. But by that time, or by today already, we are so addicted to this low interest rates that in reality, they will have a really difficult time stopping this inflation. And
well,
then
my question to you, Mark, is how to get prepared for this. I mean, I know you have the In Gold We Trust report. It's a 300-page document. Can you summarize it for us?
Yes, we write the In Gold We Trust report once a year. This is the latest piece, the dawning of a golden decade.
What does it mean?
The dawning of a golden decade. Well, we were talking about more long-term perspective this year. We were thinking about like, just as I mentioned, debt trajectories, which are already totally fixed, that that is going to get more and more out of control, and that therefore the only solution will be to monetize it, and that pretty likely will have very positive benefit for the price of gold measured in fiat currency. In reality, I'd say fiat currency will be debased, and gold always has basically a constant value, but fiat money will devalue a lot against gold relative to gold this decade. I mean, we've been talking about various things. The one main thing, we write this once a year, so it's always a little bit more long-term perspective. The one thing which we've been following very carefully during the last years, in 2017, we made a 4-year prediction kind of view, or a window which we're looking at, and it was aligned with this presidency, the term of the presidency in the US, which is now ending. And what we said then is, we had a few scenarios, and we said back then, when, remember, 2017, the interest rates were somewhat higher in the US. They had raised the interest rates a little bit, and everybody was talking about the normalization of monetary policy. And we said back then, we give this 4 years time, but we don't think that this normalization will be able to follow through. And once this normalization is obviously a failure, this will change the psychology a lot for a lot of investors who were actually still believing in this monetary normalization. And that's exactly what happened and played out not only this year, but already 2019, pre-COVID. They already started lowering the interest rates, and they started to increasing the balance sheet already in autumn 2019. Very important point, I find. So this monetary normalization obviously now is no topic at all anymore. And so the new normal is money printing, and is QE, and is possibly MMT, is possible digital currencies, and so on. And so this is the decade we are entering right now, as it looks. And due to the debt situation, it will only get worse from the debt perspective and from the QE perspective.
It's positive for gold, correct? I mean, I was thinking yesterday about the U.S. election. If we see Donald Trump winning, it could be that we see the same thing as when he won first, and maybe some people will panic. And it seems like it's positive for gold overall. And if we see Biden winning, it seems like we're gonna go. Fiscal spending like crazy as well, because that's what usually Democrats do. And so it's also positive for gold. So it's almost like it's a safe place to be in the meantime while waiting for the election's outcome.
Well, there are always risks, but I agree. I mean, our first quote, which we put in, was all roads lead to gold. And I think that really is currently very accurate. But still, I mean, make no mistake, we will have a volatility and we will have drawdowns. That's just a normal thing. But in the grand scheme of things, there is no way out than just like increase the printing and so on, and to me, I really don't see a big difference. Perhaps in the first reaction, the difference could be there could be a difference on the market, but ultimately, I don't see a big difference regardless who wins. Just a small comment still. What I think is going to be more important is not perhaps who of these two gentlemen wins the election, but how the situation will be in the Senate and in the Congress. Because 2016, what happened was that not only for most people unexpectedly Donald Trump won, but what was even perhaps the bigger surprise was that also the Senate and the House was in the Republican power after the election. So that meant you had really Republicans in both houses and in the presidency, and that's why they could basically really set through their neoliberal agenda, which is good for this fiat money debt system. So tax cuts and so on. They all were able to go through with their plan, and in this time around, I think this question will be very relevant. I think there will be a very big difference, immediate difference, if there will be a blue wave, for instance, if Democrats win both houses and the presidency. I think that would be the most harsh reaction on the markets, especially very positive for gold and also silver. Not so clear if say, for instance, the Senate stays Republican, which is still, according to the betting markets, more likely than the House. The House will not stay. Will very likely stay under the power of Democratic Party. But I'm
more on the libertarian side, and I'm always looking at. Most of the times you see that the agenda is anyways the fiat agenda, right? And no matter who wins, they will all lie this way or the other way. But at the end, the policy doesn't really change. To me, it seems like regardless of who wins, it will be more fiscal policy for sure. And then that is the determinant of what is going to happen. And talking about fiscal policy, every time I hear that word, I'm just remembering Frédéric Bastiat and the broken window fallacy, because it might be that the government are stepping in by, digging holes and filling them up again. And so it seems like there is activity going on there, but you do not see where this misallocation of capital could have gone through. What are the better mechanisms that the market could have found? And I think that's also a tragedy of the world not understanding that, because politicians will politicize, if you want, and they will only act on their interest. I don't see them limiting their power, both houses. I don't see them limiting their power if you are left wing or right wing. The end of the game is more power for us and less power for the people. So last words on this, Mark, before we close. What do you think, as a person, are the principles that we should look for, and how can we be prepared for having a good mental mindset and see this as an opportunity and not as a crisis?
Yeah, I think first of all, it's always good if one has a clear mindset about what's going on. And right. To me, I mean, I'm a little bit geeky with all this monetary system, but I think it does help even the average guy. Or I mean, also a lot of investors aren't so deep into that money creating process and what it does and so on. I think one needs to be aware what this monetary system does. It just helps everybody to get reality better, and if one grasps this and comes to the conclusion as we did, that this monetary system is not sustainable, then one should probably think about some more unconventional ways to perhaps store one's value. I mean, I'm personally of the opinion, especially in the medium or long run, accumulating some gold is definitely a good option. And working on an alternative monetary system or payment system as you do, for instance, and that's a very necessary thing and should be also supported by people if they feel the same way. And I think we need alternatives, and alternatives are being discussed, and yeah, spread the word and educate yourself, and perhaps save some sound money in the process of doing so.
Yeah, absolutely. Thank you, Mark. Thank you so much for all of your insights. I think you're perfectly right. At the end of the day, if you are a believer in the free markets, all you want is more options, and because more options and more choice is always better than not enough.
Right.
And it seems like we do not have to fight one Bitcoin or another things. I think at the end of the day, we need to have as many options as one can have, and so that will allow for the market to compete. And as it competes, then people will use them as they see fit. For example, in my case, I would see Bitcoin as a potential investment, not as money. So if I would want to have an upside on the monetary expansion, there is a case to be made for Bitcoin, but that's really a speculative move to me. If I want to preserve my wealth and be on the safe side with rule number one, not lose money, I would go to gold. I think by and large, that's the most likely consensus for a monetary reset if things really go wrong. And there's nothing wrong in having an insurance policy in that sense. I think that's actually the first thing as a responsible father. That's the first thing you need to do. So thanks again for all your words, and I'm looking forward to speak to you again. We're probably going to have more occasions. And again, don't forget to subscribe, like, and share, and follow Mark. Also, everything he does, very interesting. Your Twitter handle is?
Mark Valek.
Mark Valek. My Twitter handle is Thierry Arys. And stay in touch. Follow also everything Mark is doing on Incrementum. Agao, of course, is always here to reach out to the community, to look for support and really get some traction in there. So until next time, see you again.
Take care.
We will stand on principle, or we will not stand at all.